Welcome to The Explainer. Today, we're looking at a really fascinating business paradox. You know, in the hyper-competitive world of retail, the standard playbook is usually pretty simple, right? Sell more stuff to make more money. But what happens when a company actually decides to sacrifice some of its top-line sales? Like intentionally selling fewer items just to get a massive boost to their bottom-line profit. It sounds a little crazy, but that's exactly the masterclass in operational discipline that Duluth Trading Company just pulled off in their first quarter of fiscal 2026.
But hey, before we get completely lost in the weeds of financial tables and margin percentages, let's ground ourselves for a second. Because behind every single spreadsheet and earnings report are real, tangible products, like these vibrant Poppy Power overalls. Duluth Trading isn't just, pushing numbers around. They're outfitting hands-on DIY folks. It's the appeal of these core products, the seasonal prints, and their marketing aimed at people who really work their butts off that actually drives the customer connection. And that connection is what makes all the financial metrics we're about to look at even possible.
Okay, let's dive into this. Here's our roadmap. First, the first quarter 2026 overview. Second, the strategic sales dip. Third, expanding margins and shrinking inventory. Fourth, the bottom line rebound. And finally, looking ahead to 2026.
All right, Section 1, First Quarter 2026 Overview, Setting the Strategy.
There's really no better way to anchor our understanding than by listening to leadership directly. CEO Stephanie Pugliese has stated she was, quote, pleased with the strong Q1 results as we focus on our customers and continue to build on our promotional reset, operational excellence, and inventory discipline. Now, the absolute most critical phrase in that quote, literally the key thesis for everything we're about to see, is promotional reset.
So what exactly is a promotional reset? Well, in the retail world, brands can kind of become addicted to offering massive discounts and endless sales events just to drive web traffic and clear out their warehouses. A promotional reset is the painful but absolutely necessary process of breaking that addiction. Think of it as a discount detox. You're intentionally retraining your customers to value the product enough to buy it at full price. This means you'll inevitably sell fewer items, sure, but your profit on every single item you do sell will be much higher. It's risky, but when it's executed well, it is incredibly rewarding.
Which brings us to Section 2, the strategic sales dip, quality over quantity. When we contrast the performance of their two main sales channels, this strategy becomes super visible. Direct-to-consumer sales, which includes their website, dropped by 8.7%, down to $57.1 million. Why? Simply because they pulled back on web promotions. Without those constant flash sales, website traffic and conversions naturally dipped. But here is the twist. Consider the physical retail stores. Sales there actually went up 3.3% to $41.5 million. So while foot traffic might have been stable, the shoppers who did come in had higher average order values. They were buying more, and they were buying at or much closer to full price.
So, the really crucial point here is this. When you combine the online dip with the retail growth, Duluth Trading's total net sales for the quarter actually decreased by 4.0%, landing at $98.6 million compared to $102.7 million the previous year. Now, normally, a 4% drop in sales sends investors running for the hills. But this sets up a fascinating mystery. How did a company that brought in $4 million fewer dollars actually improve its overall profitability?
Let's find out in Section 3, Expanding Margins, Shrinking Inventory, Leaner and Meaner.
Check this out. Duluth Trading's gross margin just made a massive leap to 57.4%. To put that into perspective, that's an expansion of 540 basis points or 5.4 percentage points over the exact same quarter last year. In the simplest terms, for every single dollar Duluth earned in sales, they kept over 57 cents after paying for the cost of the goods. That is a phenomenal retention of value.
So how on earth did they achieve such a massive margin expansion? Well, it was a two-pronged attack. First, like we just talked about, reduced promotions meant an increase in average unit retail prices. People actually paid full price. Second, they improved their underlying product costs through a really smart direct-to-factory sourcing initiative. They effectively lowered what it costs them to make the clothes while simultaneously raising what the customer pays for them. And what's incredibly impressive here, they pulled off this margin growth while actively battling the heavy headwinds of rising international tariff costs.
Now, you can't really have a promotional reset if your warehouses are just bursting at the seams, right? That just forces a desperate clearance sale. Duluth solved this by slashing their inventory by nearly 25%. They shed $43.7 million in stock compared to last year. They right-sized the ship, ensuring that their supply closely matched their new, much more targeted demand.
All right, moving right into section 4, the bottom line rebound, turning red to black.
Let's think about adjusted EBITDA for a second, which, as a reminder, stands for earnings before interest, taxes, depreciation, and amortization. And it's just a great measure of core operating profitability. In Q1 of last year, they posted a nearly $3.8 million loss. This quarter, despite selling less total merchandise, that swung to a positive $2.6 million. That is a $6.4 million improvement in actual profitability, fueled entirely by those margin expansions we just looked at.
But gross margins weren't the only heroes here. They also trimmed the fat on their operating costs. Selling, general, and administrative expenses, the everyday costs of running the business, shrank by roughly $3.4 million, representing a 5.2% decrease. They managed to do this by finding efficiencies across their entire fulfillment network and reducing some personnel expenses. So not only are they making more profit per item, they're actually spending less money to run the back end of the business. It's the ultimate double win for profitability.
The culmination of all these disciplined moves is a seriously rock-solid foundation. Their balance sheet health is excellent. They ended the quarter with roughly $100 million in total net liquidity, including just over $6 million in cash. And incredibly, on a $100 million credit facility, they only have $6 million outstanding. Think of it like having a massive emergency credit card, but carrying almost zero balance. They have virtually no short-term debt pressure, which gives them total freedom to execute their strategy without the banks breathing down their necks.
Finally, Section 5, looking ahead to 2026, maintaining the momentum.
The financial guidance provided by leadership really tells you everything you need to know about their confidence moving forward. For the full year of fiscal 2026, they are affirming their net sales targets of $540 to $560 million. So they aren't expecting a massive sales boom. However, because their first quarter efficiency was just so strong, they actually raised their profit expectations for the year. They bumped their adjusted EBITDA guidance up to a range of $28 to $32 million, all while holding their capital expenditures flat at about $12 million. They are fundamentally doing more with less, turning modest sales into outsized returns. And they expect that trend to hold all year long. Which leaves us with this final provocative thought. Duluth Trading Company has proven that a promotional reset can work beautifully in the short term. They absolutely sacrifice top-line vanity for bottom-line sanity. But as we all know, the retail sector is notoriously fickle. When competitors start slashing prices during the busy holiday seasons, the pressure to join in is going to be immense. Can Duluth Trading maintain this ironclad full-price discipline in the long run? It's the ultimate test of brand loyalty, and it is going to be absolutely fascinating to watch play out. Thanks for joining me for this explainer, and keep your eyes on the numbers.